Welcome back to the channel, everyone. In today's video, we're diving deep into what's really going on with Applied Digital stock and why, despite an incredibly strong growth narrative around AI infrastructure, the stock has been pulling back sharply while insiders are cashing out millions of dollars. And trust me, this is one of those situations where the surface story looks extremely bullish, but once you dig deeper, you start to see a much more complex and risk-heavy picture. So make sure you watch till the end, because we're going to break down the growth story, the insider selling, the valuation, and whether this stock is actually a buy right now or not. And before we jump in, quick. This content is for educational and informational purposes only. It is not financial advice. Always do your own research before making any investment decisions. Past performance does not guarantee future results, and I'm not responsible for any financial losses based on decisions you make after watching this video. Now, with that out of the way, let's get straight into it. So Applied Digital is putting up the kind of growth story that usually gets investors excited very quickly. The company is focused on building and operating data centers designed for high-performance computing, also known as HPC, which supports massive workloads like artificial intelligence, machine learning, and blockchain. And instead of selling software or consumer products, the company provides the infrastructure, power, cooling, and connectivity that large enterprises and hyperscalers need to run these advanced systems. And over the past year, the company has been aggressively building out its AI narrative, especially around its Polaris Forge campuses in North Dakota, trying to position itself not just as a legacy hosting provider, but as a major player in next-generation AI infrastructure. And on paper, this story sounds extremely strong because demand for AI computing power is exploding globally. But here's where things start to get interesting and a bit concerning, because despite all of this bullish momentum, insiders have been selling significant amounts of stock, and this is something investors simply cannot ignore. For example, in mid-January, the CEO sold around 165,000 shares worth approximately $6 million. And then back in October, the CFO sold about 137,000 shares worth roughly $4.8 million. And when you see top executives selling millions of dollars worth of stock while the company is being marketed as a massive long-term AI opportunity, it naturally raises questions. Because if the future is as bright as it seems, why are insiders choosing to cash out right now? And this creates a disconnect between the narrative and the behavior of those who know the business best. Now, looking at the stock performance itself, Applied Digital is currently trading around $24.50 per share. And while it has been relatively flat year to date, it's important to understand the bigger picture, because the stock actually surged nearly 300% over the past year before hitting a 52-week high of $42.27 back in late January, and since then it has dropped, which is a significant pullback. And this kind of move suggests that the market is starting to reassess the story, not necessarily because of one single negative catalyst, but because expectations had become extremely high during the AI-driven rally of 2025. And once that excitement cools down, investors start looking more closely at the fundamentals, the risks, and the execution challenges behind the story. And that's exactly what seems to be happening here. Now, one of the key bullish arguments for Applied Digital is its Polaris Forge leasing activity, where the company has already secured around 600 megawatts of contracted capacity across two major customers, with Polaris Forge 1 tied to CoreWeave accounting for about 400 megawatts, and Polaris Forge 2 linked to a U.S.-based investment-grade hyperscaler covering the remaining 200 megawatts. And these are large-scale deals that show real demand for the company's infrastructure. And this is why bulls remain excited, because it suggests a potentially massive runway for growth. However, the market doesn't just price potential, it also prices risk. And this is where things become more complicated, because Applied Digital is carrying around $2.6 billion in long-term debt, and its revenue is heavily concentrated among just a couple of major customers, which introduces significant risk, because if anything goes wrong with those relationships, or if demand slows down, the impact on the business could be substantial. And on top of that, the company recently announced a $2.15 billion senior secured notes deal to fund expansion which, while positive for growth, also adds more leverage, higher interest costs, and increased execution risk. And this combination of high debt and customer concentration makes the overall setup more fragile than it might initially appear, especially for a stock that has already seen such a massive run-up. Now adding another layer to this situation is the involvement of Nvidia, which previously held a stake in Applied Digital but decided to exit, and that news contributed to additional selling pressure on the stock. Although some analysts like Roth Capital still maintain a bullish outlook, with price targets as high as $58, and have even bought shares on the dip, showing that there is still strong belief in the long-term AI infrastructure story. And this creates a very interesting dynamic where on one side you have bulls focusing on the massive growth potential, contracted capacity, and AI demand, and on the other side you have bears focusing on debt levels, insider selling, customer concentration, and the possibility that the stock simply got ahead of itself during the hype phase. Now if we look at valuation, Applied Digital currently has a market cap of around $6.9 billion and is trading at approximately 47 times its sales, which is a very high multiple and indicates that investors are still pricing in significant future growth rather than current fundamentals. And the stock also trades at nearly 5 times its book value, which again reinforces the idea that this is being treated as a high-growth, high-expectation company rather than a stable or mature business. And while analyst sentiment remains extremely bullish, with a strong buy rating from multiple analysts and an average to perfect, along with projections suggesting potential upside of over 300% in the next year, it's important to understand that these projections are heavily dependent on everything going right, including successful execution, continued demand, and effective management of debt. And that's a lot of things that need to align perfectly. So from a realistic perspective, while the upside opportunity is definitely there, the risks are also very real and already visible, which is why instead of viewing this as a clear, strong buy, it might make more sense to consider it as a hold with upside potential, where investors should remain cautious and closely watch how the company executes on its expansion plans and manages its financial structure. Because at the end of the day, this stock is being driven more by future expectations than current performance, and that always comes with volatility and uncertainty. So now I want to hear from you. What do you think about Applied Digital? Do you believe in the long-term AI infrastructure story? Would you buy this stock at current levels? Or do you think there's more downside ahead before the next big move? And if you have any other stocks you want me to break down like this, drop them in the comments below. And if you found value in this video, make sure to like the video and subscribe to the channel so you don't miss these deep dive breakdowns and real-time market insights.